This is Josh Jelinski, the financial quarterback. Don't touch that dial. We're with Harry Dent, recession warning signs everyone's ignoring. Harry Dent, economist since, I've studied you since the 90s. So you've been around forever, right? So many times. You're talking about a new 2025 recession. Talk about that.
Well, here's the problem. Everything was going I use demographic cycles. Generations grow up, earn and spend, predictable, age 46 peak. They save the most, at 63 right before they retire, all these things. From cradle to grave, I can tell you when they buy the most potato chips. That's at age 42, okay? So that's what I use. I can say, when are new generations of people, and the baby boom was the largest generation to come along literally in 250 years. And that's another long-term cycle I have here. So they drove this boom from 83 to 2007. So everything, I kept saying that in the 80s, hey, this is not a rebound from the 70s. This is not us getting a little revenge on Japan. They're going to fall and we're going to rise because Japan's the one has terrible demographics ahead. So that's what's happened. But what happened in 2008 is we finally did see the end of baby boom spending on a 46-year lag to the last baby boomer in 1961. And the economy got really weak in 2008, and then they tried to stimulate out of it. Well, it wasn't enough, and they kept going. They thought the first $1 trillion in stimulus would do it. Well, now we're talking about $8 trillion in money printing and $19 trillion in rising in deficits, government deficits. And now they just finally cut back on the money printing, just read last year, but they're still running these deficits in 2/3 of this massive, unprecedented 27, now going on 30 trillion in stimulus. By the way, that's 1.5 times GDP over that period. So that's how much money they poured in this economy to prevent something I predicted would happen back in the early to mid 80s when I started lecturing to small business executives and then on to investors in the 90s and stuff. So this was something foreseeable, but they thought as a short-term crisis, but they kept having to put more in money. Now we've got the most overstimulated economy in history, and poor Donald Trump's going to walk into this thing and think, oh, I can, do this and that, a little pro-business stuff. No, I'm telling you, they have stretched this economy so far to avoid a downturn from 2008 to 22 that literally would have been like the 1930s, more in that level, okay? Big bubble and then a burst and deflation in prices, high unemployment. So that's what we're doing. And so now we're coming into the millennial boom, and they drive us up from 2024 to 37 and then kind of plateau for a couple decades after that. But the best we're going to see then, but we're going to have a hard time going anywhere because we never cleared the debts and this huge financial asset bubble. This stocks, real estate, everybody knows real estate. A house that used to cost $100,000 to $150,000 20, 30 years ago is now $500 to $1 million. It's crazy. Everyday people can't afford a house. So we need a reset, but governments are doing everything to fight it. I think they're likely to lose this battle between now and 2027, and we end up having a second downturn that should have followed 2008 to 9 between 2025 and 27. We'll have to see. This has got a crack, but they blew $11 trillion just in that stimulus program. That's crazy. They blew that much just to get over a short-term virus that went away on its own, just like the influenza of 1918 to 20 did, 100 years ago. So this is a mess from my point of view. We got the millennials ready to go. They deserve their boom. The baby boom got theirs and a lot more. But I think that we're going to have trouble the next few years because they didn't allow economies. The secret to free market capitalism, folks, is not just the freedom to innovate and all that sort of stuff and free competition, all that stuff. It's also about quickly clearing out losing investments and bad debts, okay? Anytime you have a boom, even the healthiest booms, you're going to have a lot of investments that don't work out and a lot of competitors and businesses that fail. You have to clear them out of the way. We have not done that since 2008, okay? And that's the big problem for the economy. And the only way to do that is to have a slowdown and have a deleveraging and let the bad debts get restructured and written off. And that's going to be very painful for banks. But again, Banks have lent more money at lower quality loans than ever in history. So surprise, surprise. So I hate to be the bearer of bad news because I was criticized in the 80s for being too bullish. Okay. And when I said a Dow at 10,000 by 2,000 back then, and that wasn't the end of the boom, that was just the next big marker. People said you're crazy, and it went to 12,800. It went 28% higher than that. So unprecedented boom. We should have had a much bigger downturn, 2008 to 22. We blew through that with 27 trillion and still growing, maybe 30 trillion by now in fiscal and monetary stimulus. And now we're at this crossroads where the millennials are ready to show us their stuff. And I think the boom's going to be very compromised and even a bust because we never let our debts clear out. And it's just free market capitalism. You got to innovate. You also got to write off. You have to let, it has to be the freedom to succeed and the freedom to fail. My favorite economist ever was George Gilder. He's too old now, but he kept saying, yeah, failure is part of free market capitalism too. You can't just succeed.
He did some great interviews with Doug Wilson. I don't know if you saw those.
I have not recently, but I mean, I was on the speaking circuit with him, not so many years ago, and that's where we hooked up more. And man, he's the only economist I really tout. He understands free market capitalism from bottom to top. Again, not just the innovation, but having to flush out and clear the debts and stuff. So he's a great guy. I don't praise many economists.
If you're new to Gilder, folks, he still does an email. I'm on his email list. And he still throws out gems. And he did an interview with Doug Wilson. If you Google the Doug Wilson Gilder interview, he talked about economics, and I can't speak today, and religion and philosophy. And I mean, it was a really great interview. I want to say 2 years ago, it was banned by Amazon. Like they took it down.
I'm not surprised.
But it was good because he was talking about how COVID was a scam and all the stimulus. It was great. He was talked about for false news. So I know you study cycles, guys. We've had you on the great debate. One time it was Stan Harley and Harry Dent. If you remember that.
Robert Prechter, Stan Harley are two other newsletters I recommend to my subscribers and followers. Those guys all have their competences. I mean, Robert Prechter invented the whole Elliott way, which is now the way of describing patterns of stock, all types of patterns in financial cycles. So yeah, those are the two guys I really, and George Gilder.
It's funny. I had one guy, I will not name him, but he's a very famous cyclical analyst. And he knew nothing. He talked about this cycle. I can't even say the cycle because it would reveal the guy. He was a very nice man. We actually had Stan in the office. And Stan was in the studio and he was being polite because Stan could have wiped the floor with him because it was basically cyclical analysis it's always changing.
Well, the cycles don't change. The sun doesn't change around work, but which cycles matter does change over time in history.
And as Stan says, he's very bearish right now. He thinks we're going to go into another recession.
Depressions follow bubble booms. Recessions follow normal booms like the 1950s and 60s. That's a big difference. So this is even worse from my point.
The only thing I think we have going is what they're doing with Doge to try to rein in the debt. I don't know if it's too little too late, but we'll see.
But when you rein in debt, that's what happens in a recession. Bad debts and marginal companies fail, which only makes us healthier. What doesn't kill you makes you stronger. That's what free market capitalism is. It's competitive. It's not nice, okay? That's what makes it great. And what economists end up wanting and government officials is they want the booms and not the bust, And they want the successes and not the failure. The failures are equally important. You have to have a lot of companies try something new to get a few successful killer apps, they call it.
Yeah, it's like who wants to go to Kmart? Who wants to search on Yahoo anymore? Who wants to go to Sears? All of those have gone the way of capitalism. They've been victims of capitalism.
Mature businesses are now slowly declining. And if they do not innovate and jump into new markets, especially with the new generation, and like the baby boomers didn't even like Sears and some of these companies. I'm like, imagine the millennials. These are like dinosaurs.
I've said this all last year. I said, we're going to have a great year in 2024 because the powers that be are going to prop things up. And then I said, watch Trump get elected, and you're going to hear every day the news media is going to say recession, 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 and eventually people will believe it. We're going to talk recession. I also want to get if there's any good news, but recession, Trump, you start seeing people, Warren Buffett's moving to cash.
That is rare. Warren Buffett moving to cash and visibly doing it is pretty rare. That is something to notice, okay? I have my different reasons. Again, I understand what the economy should be by the things that are predictable cycles, not just cycles, but things that matter, like generation cycles of spending. And the economy the stock market is way higher than it should be, okay? They've constantly put money into the economy. You know how they put money in the economy? They buy financial assets. They buy bonds, which then trickles into stocks and real estate. This is the greatest financial asset bubble in history. And the problem with that is, unlike the roaring 20s or even the roaring 90s, which is the best decade we've seen, and then, of course, Bill Clinton, luckiest president in history, okay, that we don't have underlying good economy. The Generation X should have brought us down the last 14 years. And a lot of companies should have had to shake out and fail that were marginal. And we did none of that. So that's the problem now. I actually want this sounds sick. I want a recession because the economy has to flush this stuff out. And I ask people, how long can you go without sleeping? Recessions and booms and recessions have the same ratio, about 70-30, as waking and sleeping. People think recessions are the enemy. There's something wrong with the economy. We should avoid them. Recessions are more necessary because that's where all the innovation comes from. People don't innovate until they get their kicked. That's the real truth. So booms allow the innovations of the last challenging recession period to then move mainstream into growing generational markets, for example. And so that's how the economy works. So you can't always boom, and you want to boom when a generation is at its best. And that's the problem. The millennials are not going to get their boom, at least not for a few more years, because we didn't allow the economy to clean out during the Gen X downturn following the baby boom. It's that simple. So we thought we could go, the dream of every economist, no recessions. What it tells me, economists don't understand our economy. I was a turnaround manager in the 80s in new ventures. I understood new technologies and new products emerging with a new generation buying them versus the old. And I understood that failure's good. When I used to get companies that were failing, I could make 5 times the progress in half the time when a company was in trouble and there was no resistance to change. You just it's do or die. That's when innovation happens the most. That's when companies can change the fastest. There's nothing wrong with recessions. If you have healthier booms, you'll have less nasty recessions. But if you think you can get rid of recessions, then you are like economists, never had sex, never run a business, and don't understand human nature or the economy.
What about those who say the recession was in 2022, the Biden recession, the 2022 to 2023 crash?
That is not a recession, and certainly not one commensurate. The bigger the boom, the bigger the bust. Okay. I mean, this boom since 82, and particularly in the 90s, that was the sweet spot of it. But all the way past that in the 2000s, that was the greatest boom in history. And we had a 1.5 year short recession that was cut in half. Government stepped in and said, no more, blew that recession out. My famous statement that I'll remember the rest of my life, Mario Draghi in the European Union, the Fed chairman over there, and told investors, you short this market and I will blow your out of the water. That is not free market capitalism. That is the opposite. That's a top-down managed economy. We don't want any recessions. We only want booms and not busts, which means you don't understand the economy. And not one Fed chairman's ever run a business. Not one that I've ever seen.
But isn't that what we have now? Chairman Powell, 2020, March COVID.
That is what we have until it goes wrong. Then we'll see how many creepy crawlers there are. The longer you go, the more creepy crawlers, even in a healthy boom. Businesses are always going to make misinvestments and mistakes. That's why you slow down now. And that's why we sleep. People think, oh, you're wasting time sleep. You're not wasting time in sleep. The mind rebalances all types of stuff. Body rebalances all types of stuff. Sleep is necessary. And how you know it, I dare anybody in this audience to go more than 3 or 4 nights in a row without sleeping and see if they can still even stand near utter a full sentence.
Without a doubt. You're predicting the greatest crash of our lifetime. When will that occur?
It should have happened 2020 to 22 in that period. Major crashes like 29 to 32 and then 72 to 75 usually take about 2.5 years, sometimes up to 3. And again, that's how long it takes to flush out all the bad businesses and marginal loans and all this sort of stuff. And again, it's like losing weight. It's like running and eating healthy for a weekend. It's how you stay healthy. So there's nothing. That's how the economy actually works. It's never worked any other way, ever. I've researched back to the beginning of the agricultural revolution 8,000 years ago. There's always booms and busts. There's always inflation and deflation. There's always a 4-stage innovation, growth boom, shakeout, maturity boom, decline cycle, and everything everywhere, just in bigger or smaller cycle. Now, this is universal stuff. Economists don't understand this. They think the economy is a machine and they can just crank out. A machine can do that. A machine can just crank out 1,000 parts a day and keep doing it, hardly ever take a break except for a little maintenance. This is not a machine. It's an organic process driven by people at the end of it. And I'm the only guy that's done the research, which is most available in the U.S. and anywhere, on what people do for their entire life cycle, when they spend on everything, when they earn the most, when they borrow the most. All of this is in the average family life cycle. So it shouldn't be a mystery that we had this great boom into the 90s when people thought the 80s was just a rebound in Japan and East Asia were going to take over the world and the U.S. was going to die along with Europe. Well, no. I was saying Japan's the ones that are going to die. They're the ones that didn't have any babies, and they're the ones that are going to fold in the 90s after finally blossoming in the 80s for a short period of time. So again, I'm just looking at facts. 46-year lag on the birth index in any major country in the world, and even in emerging countries, will tell you more about where things are going, and for decades, not years, decades, and regardless of the politics that goes this way and that way, Republican, Democrat. You know how much time I spend analyzing who's president and care? I don't care at all with my foot. Almost don't care at all. Only in extreme circumstances.
So we're going to talk about millennials. We're going to get your opinion on immigration policy and more. But let's talk about millennials. You mentioned, and I've studied this, we could have this boom, this economic boom with the millennials. That is set to happen now?
Yes. The millennials should be in a rise. The baby boom was a rising cycle from the beginning of 1983 to the end of 2007. I predicted that from day one, and people said, you're crazy, we're a has-been, we can never compete with Japan, we won't have any jobs left, blah, 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 blah. And I'm like, no, Japan's the one dying here. They're the aging country. And that's just a simple fact. So I wasn't even speculating there. So now we have, the baby boom did that, 83 to 2007. 2008, deep, not just there was a deep recession. And then when it got bad, they printed $1 trillion saying, well, that ought to handle it. Didn't even phase it. Why? This was a long 12 to 14-year downturn that was setting in just like 68 to 82 after the Bob Hope generation and just like 1930 to 42 after the Henry Ford generation before them, okay? So again, these cycles are predictable, and during the downturns, the economy does what it does. The downturns create challenge, new innovations. That's when they come out. And that's when you reduce all the bad debts and clear out the wreckage from the past boom and get ready for another healthy boom. And that comes now for the millennials, their boom is the beginning of 2024. Rising the most into 2037, okay, and then plateauing into about 2054. Okay, that's how exact I can get it. That's a 47-year lag instead of 46 on their birth cycle, and I adjust all the legal and estimated illegal immigrants into that as well, because we know the ages of immigrants.
So then we could have a boom now.
No, there should be a boom. It will not be as dynamic as the baby boom, much steeper, but it will be as long or longer. No, the millennials should be booming from 2024 into 2054, over 30 years. I'm saying they're not going to get that boom, or not much of it, until we clear out, which we should have already done years ago, clear out the debts and zombie companies. And zombie companies are also at record highs. Debts at beyond. We shouldn't have high debts at this point in the cycle, is the point, okay? We should have cleared them out. So that's the problem. Millennials are set to go. And in fact, people wondered why the strongest tightening cycle by the Fed since the early 80s did not have much effect. It's because the millennials clicked in 2024, right when that would have been hit the most. So the problem is, how are the millennials going to make any progress when they're carrying all these bad debts and zombie companies from the last generation? That's what I've been calling the crime of our lifetimes, that we don't clean up after one generation and the next generation does not get to fully experience their rightful boom. And the millennials are screwed at this point until we have the shakeout. Will hurt millennials at first. Any shakeout is going to cause unemployment and business failure, but it's the one thing that will clear the decks for the millennials to have a boom that's worthy of their generation.
For those who don't know Harry's known for these kind of bombastic predictions, but he runs a newsletter. In the newsletter, he will say, hey, you're not as bombastic in your newsletter. Like you're very thoughtful in that you kind of look at things and say, well, this is why I'm bullish. If this happens, I'm bearish. If this happens, you're not a perma bear as you're often described.
I was criticized for being way too bullish, and I was not bullish enough in the 80s and 90s, okay? Yeah, oh no, I have been way more bullish and criticized more for being too bullish than being too bearish.
So where do you go? Like, what's the setup? Take me through the next 12 months. Because this is, I want to be clear, you're primarily a demographer studying economics, right?
No, I am primarily a cycle guy. I study all types of cycles. I got cycles. You think I was, needed to find a girlfriend. Okay. I got so many cycles. Okay. It's a matter of what cycles are important. We're in the middle of a 500-year cycle, which is the most powerful cycle in history since Greek times, okay? We're in the smack middle of that, which means really, but you also get a shakeout in the middle of most acceleration cycles, and that's what we're due for here.
No, but cycles are everything, and I've spent years studying with Stan Hartley and others, and people will crucify a cycles guy typically for calling something wrong. So Stan, for example, will say, I'm predominantly bearish right now. He's very, he's predicting we're going to basically, the market is not going to get any higher than it did. So where he is today is February 19th was the high on the S&P, and we will not see that again until 2029.
I think we may not see it until 2037, if then. Because the next boom will not be as bubbly. So this boom has not been a normal, strong boom generated, by strong technology generation. It's had this bubble. We don't have the last bubble era we had was the early 1900s into 1929. So we have bubble on top of this. So the reason I don't think once we have a worthy correction that stocks, even when the millennials are at the peak of 2037 of their impact long term on the economy, I don't think we'll get to new highs or back to these highs, because we won't be as we will have taken the bubbliness, which is about a 50% premium, out. So I don't think we'll see new highs even in 2037, but we can have a strong boom from here into 2037 if we get all this rubbish out of the way and have a good, healthy recession. And there's no other way to do it.
So to me, we have so many bubbles. We have a debt bubble. We have a real estate bubble.
This is the everything bubble is the most appropriate phrase I've heard. Bubbles in everything. The Roaring 20s hardly had a real estate bubble because it's too hard to borrow money back then.
So we have all these bubbles converging, which is the negative. What are the positives? What changes you from bearish to bullish?
The biggest positive in the world and it's beyond demographic. It's urbanization. U.S. and Europe urbanized a long time ago, and we're mature in that, and we get a little more. Okay, the whole emerging world, the other 7 billion, going towards 10 out of 11 billion, by 2100 and before that, likely. That's the real trend. Or when people in an emerging country move from a rural area to an urban area with no increase in education, just into a better, much more specialized urban job market, you get 3 times the GDP per capita, 3 times just from urbanization. So what's happened now, the entire developed world has fully urbanized. We're at 87% urban. Japan's at 92% because they're so small and concentrated. Europe's similar. We can't get much more. Okay. So we're just still growing on productivity through technology, but demographics, we peak. The baby boom's as good as we're ever going to see in the foreseeable future, and Europe less so. And Japan and East Asia are going to continue to fall off a cliff, and so is Southern Europe. Okay. The future is the emerging world urbanizing. And of course, they have younger populations, so their demographics are strong for a long time. But the urbanization is the bigger factor because of that 3x. You go from like 20-year-old young new worker to 46-year-old peak spender and worker, and you may be 2x. Okay, your spending and productivity stuff. Urbanization takes people 3x, so it's even more powerful. The entire third world has been urbanizing since the 60s, particularly, and will continue to urbanize into about 2100 before they are all urban, 80, 90%. And then their spending waves will play out from there. And I can predict today that the world will be at its best around 2140. That's just to show how predictable things are long term. Nobody's going to care about 2140, but your kids and grandkids will. And that's the biggest positive. The biggest positive is that life expectancy has been growing dramatically in the third world as they've gotten more affluent. I think the developed world is going to undergo an aging revolution where we start to live to 100, 120. I'm not going to live to see that, okay, fully. But that should happen in the coming decades. I mean, the technology, biotech and stuff is in its infancy. So that's going to be huge. Because what happens is people enter the workforce between 18 and 22, most people, high school and college, peak by 46 after their kids leave the nest. And then they kind of plane out in the 50s, and then they just slowly die off in the 60s until they disappear and go back to zero. So this thing about people living much longer, once you get them educated and they enter the workforce, say in their 20s, and maybe it's a little later in the future, but then they can work until they're 80 or 90 and maybe have 2 or 3 careers instead of one. That's a whole new world that could happen. And that's what happens. There's always progress. You can know it's coming. I can tell you the cycles like this. This 500-year cycle is at its apex in 2140. Okay, that's why I quote that number. So that tells me that even though aging is a problem for developed countries, we are probably going to break through that and start living longer, and aging will no longer be the limit it is now. And the affluent countries will always be more affluent. The emerging world, most countries will never be as rich as the developed.
People have often said, well, why is there a real estate bubble? Is it not because boomers are living longer, and where they used to downsize, now they're buying a second home. They're not really downsizing.
They're buying a second home, and their second home's likely to be in Aspen and be higher quality, more expensive than their main home in Ohio. Exactly. That's exactly what's happening.
It's almost screwing up the cycles.
And I tell you, when did the parents have fun in life? When the kids leave, okay? That's when you get that Aspen home and really say the cost is no object. And when we go out to eat, we're going to spend $300 a night and not wink at it, okay? No more McDonald's with the kids. So yes, affluence fosters longer aging, and so does better medical care. But I'm telling you, it's way more affluence than medical care, okay? Affluent people live longer.
Why is that, you think?
Because they're healthier and they don't die by accidents. A lot of deaths over time are just different accidents and stuff and all. over lifetimes and ailments and stuff. We've known recently 5 people who got cancer, and only the one, unfortunately, was my partner who got brain cancer, died. Everybody else, basically, they were able to even defeat 4th-stage cancer. 20 years ago, they wouldn't have been able to do that. Well, think 20 years from now. That may just be nobody gets cancer for very long. And that's when I say people be living instead of to 80 typically now, they could be living to 100. Then you go another 20, 40 years. They could be living to 120. The oldest people on earth have always lived to be 120. That's the limit. So I think humans are heading there long term. And I look at my cycles. What's the cycle that would most foster that? The most powerful cycle is that 500-year cycle, which would peak around 2140. Even after we're baby boomers are long gone and demographics don't look so good. If people live longer, it's going to extend all the demographic trends dramatically.
What investment theses do you like in this time of uncertainty? What countries do you like? Do you like gold? Do you like treasuries? Do you like Argentina?
When it comes to everything, Bo, and everything is the key. Even the roaring 20s wasn't as much real estate, much more stocks and business, okay? Everything has bubbled, okay? All types of real estate, all types of stocks, all around the world is bubbled. What happens when we crash, the emerging countries are going to come out much stronger and have much, much longer to boom. And the countries that are younger or have stronger millennial generations, again, the weakest parts of the developed world are East Asia. And that, folks, includes China. Everybody's talking about China's going to take over the world. China is going to shrink from 1.4 billion people now to 780 million in the next 50 to 60 years. Shrink by 40% because they never had kids. And now when they finally let people in China have kids, and they say you can have 2, they say, why would we have 2? We're much better off with 1. They spoiled their own culture by showing them you can have 1 kid and get them into Harvard, but you can't get 2 kids if you're an emerging country into Harvard. So the Chinese don't even want to have 2 or 3 kids now that they found out that they're a lot better off with 1. So again, that's how things change, and that's predictable. People have as they get more fluent, they have fewer and fewer kids. Okay, I mean, and in emerging countries, as they urbanize, they get this 3x factor for just moving into cities with much more specialized job markets, much more growth and everything. I mean, so that's what I'm telling you. People focus on what's not predictable, and most people say the longer you go out, the less predictable. I'm the opposite. I'm more worried, like Stan Harley, what the hell's going to happen the next year or two after this bubble of it burst and how bad it burst. That's got a lot of ifs and ifs in it. There's no ifs about India becoming the next China. They're already at the same stage of urbanization, wealthier than China, and nobody notices that because they're only 1/5 of their wealth. But they're at 35% urbanization, not 65%. That's a huge difference. And India keeps growing their population, and China's going to shrink. These are obvious things, okay? And people and economists don't see them because they don't look. They don't even think the future is predictable. They think, well, if politics does this and the Republicans do that and the Democrats don't do this, well, then maybe we can grow for the next 3, blah, blah, blah. That's all short-term stuff, and that's actually harder to predict, the shorter term. Long-term is a piece of cake. Countries are urbanizing at 1% a year, as in China, and that causes this much rise in GDP per capita. Baby boomers enter the workforce in 1983 and exit in 46 at the peak in spending for, predictable. I predicted all these things way back, and people laughed and said, Harry, nobody can do that.
No, I remember the China prediction. You predicted China would be nothing, wouldn't be a problem. And you're proven right.
When I was starting to speak, everybody thought Japan was going to take over the world. I said Japan is going to be the first developed country to fall on their face and die in front of us. And that's what they've done. And they're only halfway through that process. They got many more decades to shrink.
Now, Trump's MAGA policies, will there be any chance they create a boom in the economy?
No. I mean, a little bit, but again, you're stretching the economy. We got a problem here, especially with COVID. They so overreacted that they really reignited inflation that was dead. And my indicators say inflation should be 1 or 2%. for the decades out because of the aging of the population and less people. Young people are inflationary. Uh, People in their middle are boom, and older people are deflationary. Okay, it's that simple. Old people just get older, slow down, and die. Okay, young people cost everything to raise. It's not just parents. Governments have to school them. Businesses have to hire them and train them. Research shows that businesses don't break even on a new hire. I mean, a new person in the workforce for 2.5 years. So that's what I do. Workforce growth on a 2.5 year lag. That correlates with inflation better than any indicator in history. And it's also simple, like a 46-year lag for peak spending. This is simple demographics. People doing predictable. People don't think they're predictable. People are just doing what they do. It's groups of people that are incredibly predictable through the law of averages.
No, what I'm worried about is the next 6 to 12 months. Like you said, that's much harder to predict.
It is. It's also pivotal, though. I mean, in other words, since governments are actively fighting this downturn, they know it's a bubble.
But don't you think they want the bubble to burst for Trump to be blamed? No?
The bubble bursts on your watch, you're dead. You don't have any chance of getting elected.
No, I know Trump doesn't want a bubble. What I'm talking about, this is pretty crazy. The last few weeks, did you hear Stephen Cohen?
No.
The interview, Mets, owner of the Mets, Stephen Cohen, big hedge fund manager, he started signaling a potential downturn. So to me, we have this weekly, monthly indicator that kind of went bearish, which got me a little alarmed last week. When that starts to be bullish, I'll be bullish again. Right now, I'm bearish. Any indicators you're looking at right now?
But right now it's gotten so convoluted. A lot of things that used to work don't work and stuff. Everything's been perverted. I'm looking at technical levels. Like we've got to plow through the late 2022 stock lows. Any index you want to look at, NASDAQ, QQQ, S&P 500, the DAX in Germany, on and on and on. The key indices have to plow through the late 2022 lows. And my target for a bottom in the crash of a lifetime, if it goes that far, and we need it to, it would be to just go back to the 2009 lows. That's not that far from, and that's the last major lows. Any long, if I put these charts in front of somebody that didn't know what they were, but they were a long-term chart technician, they would look at this and say, "Oh yeah, we had this boom up here, and we go back to the fourth wave low back in early 2009, March of 2009. Well, you know what that is? That's 84% for the S&P 500. It's 94% for the NASDAQ. It's a lot worse than people would think just to go back to the last major low. That's how much we bubbled up the economy.
No, I could see us go to the lows of 2020 or 2022. I don't see 2009.
This is not a serious correction until we break through at least late 2022. That's when you can start to say, okay, this is not another ordinary correction. This is probably going to go deeper. So that's what I'm looking for short term.
I mean, I'm a big cycles guy. And if you look, there was that 7 to 10 year cycle that was like a clock every 7. And I firmly... And they seem to stretch that out. Like the people at the Fed knew about that one and they tried to just bazooka money to stop it. I don't think they'll let it go that far.
Okay, let me ask you one question. Who blew up this entire bubble? Who's been driving this entire bubble? It hasn't been the baby boomers, hasn't been demographics, hasn't even been G Wood's technology. That's part of it. These people created this bubble themselves. How can you go to the Fox to save the hen house? These guys are going to, my point of view, and if they don't, I'm going to quit economics the next few. If they don't get their ass kicked for this, then I don't believe that there's a God of economics, and I don't believe there's any predictability myself either, after believing economies are far more predictable than people think. This is crazy. You don't get something for nothing. When all you do is print money and run deficits, government spending money they don't, and float it through long-term treasury bonds, which they still don't get penalized. They don't get any premium from issuing so many treasury bonds. Well, there'll come some moment where that clicks and people say, oh, wait a minute. The U.S. government is no longer a risk-free borrower. Oh, we're not going to lend to them at 4% long-term anymore. It's going to be 6% like a corporate bond. And if they get, that would, what that would do to our interest and deficits and it'd be death. So I'm just saying, People say, oh, it can only go down so far. No, you haven't looked at how much it's gone up and how much it's been inflated. If we just deflate the financial asset, let me give you a number, okay? This is the most important number in the world. I should have brought it up earlier. 630 trillion. Anybody guess what that is? All the financial assets and money in the world. All money, financial assets, everything, every type of financial asset, derivatives, stocks, real estate, commodities, gold, okay? All at 630 trillion. That's 5 times GDP of 105 trillion. You know what that normally is? 2 times. 3 at the worst tops in history. And it's 5 times. Okay, so 630, let's say it just goes down in half. 300 trillion, 315 trillion disappears from the global economy in financial assets, which people are going to retire on. You don't think that's going to cause a shock that you never even recover from? If anything, I'm overly optimistic, and so is Stan Harley, frankly. I think they will do stuff to support it. They are going to try to stop, but I'm telling you, when you create a bubble that big, beware when the dam breaks, okay? Because it's just too hard to stop. That's my view. If this was a normal boom and they're, yeah, we fight recessions. Yeah, they'll do that. No, they're the ones that they did not create the bubble in the 90s. That was a total natural bubble. So was the roaring 20s. The governments did not largely create those bubbles. They maybe helped a little bit. They 100% created the bubble since 2009. Longest, biggest, most global. No way these jerks are going to be able to stop the very thing they created, Frankenstein, okay, out of Mr. Hyde. They're Dr. Jekyll. They go down with Frankenstein. End of story, from my point of view. I don't even know how it happens. I just say they go down, and I hope they do. I hope I live long enough to see professors in college and economics saying, well, we'll never make this mistake again, thinking we can grow and avert a crisis simply by printing money out of thin air. I mean, doesn't that sound stupid? What do you think? I mean, nobody would have believed that 20, 30 years ago. Now everybody's like, well, it seems to work. Well, bubbles work as long as they work. Bubbles only end. If you can find me a bubble that has ever ended nicely or over time or gradually, I will kiss your you-know-what in public, okay?
No, but every 2 weeks, your pay, we have, people are putting their pay. It almost creates a false put on the market. Have you ever thought about that?
Well, that's how you get a bubble. It keeps coming in. But the point is, anything can get overvalued. And I'm telling you, I can't even compare this bubble, length or height, to any bubble in history. The problem is, once you get a bubble of this magnitude, it's not sustainable. And when it bursts, it's just like a major dam bursting. It's too hard to stop at some point.
Mass carnage. What about real estate? People think that's the safe haven. What do you think?
Real estate's the word. I can sell my stocks in a second when I want to. Wait until real estate start clamming up everywhere. You will not even be able to sell your house at any reasonable price. I'm more scared of real estate. Yes, it will not. Real estate, if stocks go down 80-ish, real estate will go down 50-ish, okay? But real estate is mortgaged up to 80, 90%, and let's say 50% on average. So that doubles the loss, okay? So real estate is what's going to hit. Would be different than the roaring 20s burst. That was not primarily a real estate bubble bursting, only minor. And this will be the second real estate bubble to burst after 2006 to 12. And that was only 34% decline. And that caused a lot of damage to a lot of people and a lot of portfolios because of the leverage in real estate. I think this one's going to be, and it's just simple, very simple. We're just going to go back down. In this case, just to the 2012 lows, that would be 60%. And 60% on leveraged mortgages. Oh my God, tons of people are going to be underwater. Banks are going to fail, and governments are going to have to bail them out or just basically reboot the whole system. I mean, that real estate's the biggest problem.
But what about the people who bought 30-year fixed mortgages at 3%? So they're not going to be foreclosed on like the ninja loans of 08 or the boomers who bought that second house with cash. So I've had another demographer on because I kind of see what you're saying more. I had another demographer. He said, well, there's not enough houses. There's too many people who want homes with the millennial boom. So it'll create this false bottom in the real estate market, or maybe it'll go down 5 to 20%.
Well, you ever heard of people dying? When people die, they don't go from a 50,000, a 500,000 home and trade down to 300,000 in retirement. They die. They're dead. They're gone. Those are sellers. You know what I do? The biggest change in my forecasting in the last 20 years, I realized everything that I predict by lagging for the peak spending of a sector like real estate, and that's 42, by the way, not 43, not 41, 42, okay, in normal time. I have to subtract dyers because they're sellers. Even if their kids take over the house, that's a house they will not buy and get a mortgage on. They'll just inherit it from the parents. That's it. So that's a negative. So that's the big factor. Nobody's looking at the dying of the baby boomer. You know when the last baby boomer dies? 2041. Anybody is your demographer telling you that statistic? Well, your demographer's missing the biggest single trend maybe in all of demographic history because he didn't consider, well, what happens when people finally just croak and die and disappear instead of spending less? The last boomer in 1961 dying at 80 on average in 2041. The last peak boomer. That's going to be the biggest drag on the economy, and it hits real estate. It doesn't hit stocks as much as real estate.
It's not going to hit it as much now as in 5-10 years, though.
It's going to hit from now until then. The biggest single trend that no demographer's talking about, because if you're going to study demographics, you got to study the whole damn thing. The biggest problem with any analyst is they choose things they like, and they choose things that are favorable. People don't like to look at the truth. The truth is the baby boomers caused the biggest boom in history ever, and there will not be one in the developed world to follow it ever. It reached an end time frame into 2007, and they will cause the biggest dying trend in history, and that will be painful. There's no two ways about it, period. What could be worse than dying?
Boomers saved, their kids don't. When the kids of boomers inherit the money, I'm amazed at how the kids of boomers blow the money. They take the money and they run.
But when the baby boomers are dying in their 70s and 80s, low 80s, the people inheriting, the millennials behind them, are going to be past their peak in spending already and moving towards retirement where they're saving more of that. So they're not going to have the same impact. You're right. If a bunch of young people inherit a bunch of money in their 20s, 30s, it would go right into a bigger house and a better car. But it's not going to happen with people moving from their 50s into their 70s or 80s. It's just going to make their retirement more comfortable.
It won't have that stimulative effect that people have said, oh, the boomers, the biggest wealth transfer in history. I've not seen that.
And again, baby boomers are intending to pass how much money? Well, what if that money, which it will, gets cut in half? They will not transfer as much as being projected because the same demographers don't study dying. They study the good stuff, not the bad stuff.
Do you have a book on this? That actually would be a good new book for you.
I'm probably going to do one more. I'm going to wait till after we have a good crash and see if the economy gets back to real. I don't even want to write another book. The newsletter is the best thing. I agree. And I mean, I have a free one. And a paid one. But harrydent.com, you can get on our free newsletter. You get an article and chart from me every week until you figure out, well, maybe I ought to listen a little more and things are looking a little screwy here. And then I have a paid newsletter. But people can get on we have a good free newsletter.
So what is the best, and we're not giving investment advice, but what are asset classes you like in the next crash? Treasuries, insurance products?
Two really, really large, well, insurance maybe, but really there's two things. In a downturn, it gets much more narrow, especially a bubble and everything bubble crash. Remember that everything bubble part, okay? Apartment buildings will hold up much better than upscale houses will do bad. Retirement houses will do a little better. They'll be different things, but I like gold in the early part of the next downturn. Gold will kind of hang up there and keep kind of edging up until they see the deflation. And that's what happened in 2008. Gold edged up, went higher at first, and then crashed for a short period of time in the second half of 2008. And gold only went down about 40% when it did. So gold is a pretty good place to be, but particularly it's a darn good place to be in the early stages. But the ultimate savior, without a question, one and only, is the longest term U.S. Treasury bonds. And everybody said, but Harry, we're too much in debt. And then, yes, but we're the best house in a bad neighborhood. Okay. We have less debt and we're aging less fast than East Asia and Japan and Northern Europe and in most of Europe. I mean, Southern Europe, especially, I'm sorry, Southern Europe more, and similar to Northern Europe. So our Treasury bonds are the safe haven. Your only other choice is to be in very short-term bonds or in cash, let's say T-bills, and make, well, by the time it goes, you'll be making zero. You won't be making 4% like now, but you make some interest, you're safe. But the Treasury bonds, when you go into downturn and you get disinflation from deleveraging, then those 30-year bonds, you locked in a 4.6% 30-year bond. And now, and not too long ago, they were yielding 0.4%. Okay, those bond yields go down towards zero. Oh, your 4.5% bond would double in value easily, like a stock. So the best play, and it's going to come in the second half of the downturn. So I'd rather lean more towards gold going in. And if the downturn starts to get worse and worse and prove itself and break some of those key levels like the late 2022, then you start getting in the Treasury bonds. You can do it through an ETF called TLT. That's an average of 10 and 30. So it's 20-year average. But the 30-year Treasury bonds are the best single deflation hedge and basically depression hedge you can possibly be in. Because they will not default, because they're the only entity, one of the few in the world, that can print money. Corporations can't print money. If they're in trouble and got to pay off their bond, they got to raise money at a high price to pay off the bond. Government can still print money.
As we conclude the interview, what other things have you been studying lately that you want to share with our audience?
Well, the major thing, I've just been reviewing some of my older cycles and looking back at great. I mean, you wouldn't believe. I mean, I was able to go back and trace, not GDP, it wasn't even a word. Nobody calculated that, but everybody talked about inflation and deflation stuff. Inflation was something I tracked all the way back to 500 BC. It's going through The History of Civilization by William Durant. That's about 10,000 pages. I took a year or two and plowed through that thing and documented every mention of inflation and created my own long-term inflation index. And that's just mind-blowing. First of all, the first insight to me, everybody thinks inflation's a bad thing. Long-term, it's a sign of a higher standard of living for more people doing what they do best and specializing and charging more for that, and then delegating tasks to people who do lesser stuff. It's a pause. Inflation is the best sign of long-term prosperity and easier to track long-term. So sometimes I just go back and review those long-term things. And that's when I go, hey, people may not believe we could boom this much, or we could, and all I've had is criticism. Oh, Harry, it can't go that high. Can't have a Dow at 10,000 by 2,000, blah, 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 blah. But to see what the Dark Ages was a 500-year depression on a 2,000-year cycle. So what is that? A quarter. The winter season of a 2,000-year cycle that saw the Roman Empire into 160 AD at about the same place that the U.S. and the developed world is going into 2140 on a 2,000-year cycle. So every once in a while, I get the most joy about looking at long-term cycles. It's just my own indulgence because nobody cares.
34 to 40-day cycle. I like that.
I see these little Elliott waves and patterns, and the smaller cycles are the biggest.
It's everywhere. So we're at a low right now. You go 40 days back, and 40 is all over the Bible. You could look at 40-day cycles in the Bible. Stan has said he's not as much of a theological guy, but he always talks about a 34 to 40-day kind of pattern.
Yeah, you've heard of sell in May. The markets tend to be up, down more from May into October and up more from November into April. I mean, if you just did that every year systematically, you wouldn't make it in every year, but you would make money doing just that. So that's a 1-year cycle. And what is every year in the weather? We have spring, summer, fall, winter. You cannot look at anything closely and not see cycles. You know why people don't look for cycles? Because they don't like winter. If you look at a cycle, you're going to realize, oh my God, there's going to be a winter and everything's going to go to hell in a handbasket. That's the reason people don't like cycles. You have to have a little guts like Harley and me and people like that to study cycles. And Prechter, I studied Prechter and James Dale Davidson early on before I wrote my books, because they were some of the best cycle guys back then. And they were the ones that introduced this 500-year cycle. That's the most powerful cycle in human history, 500-year cycle.
We used to have a lunar calendar. So we used to have 28-day months. People forget this.
That's right. And it's not, yeah, that's right. It's not 30, 31 days.
And that was cyclical in nature with the moon and the tides. So we were kind of indoctrinated into the cyclical nature of life. A cycle is not always determinative. They expand and contract like an accordion. So this is good.
The key thing in cycles, there's zillions of cycles on all levels. The hard part for me is what cycles are most important. And I came down to three: a technology innovation cycle, generational spending cycle, and a geopolitical cycle that it goes from positive to negative. And you know what? The best climate scientist, Milankovitch, he had a 100,000-year cycle, 41,000, and 22. Similar cycles on just a much grander. He could explain all of climate, past and future, with 3 cycles. And I can predict the economy decades ahead and track it past, except when governments intervene on this level and muck it up. And of course, that's only going to last so long.
Well, thank you so much, Harry Dent. You can go to, is it hsdent.com or harrydent.com?
harrydent.com. That's how you get on our free newsletter.
Great. harrydent.com. Thank you so much for joining us, Harry.
Okay. Thank you, guys.
A lot of fun.